Hey everyone, Drew Creekmer here, Wealth Advisor with Creekmer Wealth. Hope you guys are doing well since the last time that we chatted. In today's flash briefing, I want to do just kind of a quick lay of the land, kind of review some economic data that's come out recently, and give some context to what we are starting to see. We all know that the past year has been unprecedented in many ways. We're not going to rehash that here. But what we're starting to see now is some of the reverberations from the economic decisions that were made over the past year. And as we learn more about those reverberations, we're going to be able to better project into the future how the decisions of the past 12 to 18 months are going to impact us for years to come. And so really quickly, last week we had some data come out about retail sales and manufacturing. And so from February of 2020 through the end of this past April, retail sales increased by 17.9%. That is a huge leap. Just for some context, that's the fastest gain in retail sales over any 14-month period going back to 1978 and 79, which for those of you who were around back in the 70s, you know the 70s were known as the decade of inflation. And so back in 78 and 79, there was double-digit inflation going on, whereas from February 2020 through April of 2021, we had inflation of about 3.1%. And so what we are seeing is really what's happening from a government stimulus standpoint, having gasoline in the form of stimulus dollars being dumped on our economy, trying to get the fire going again, so to speak. And we are seeing that retail sales are up. People are spending money. That is a net positive in the short term for the economic recovery. However, more longer term, on the downside, manufacturing production over that same time period of February 2020 through April of this year, manufacturing production was actually down by just over 2.5%. And so what we're seeing is an imbalance between the amount of goods and services, products that people are buying being massively high, and we are seeing production being low. And typically when you see that, what you're going to begin to see is inflation creep into the economy. And I think we're all starting to see that. And the data that we are seeing underlying things is proving out that that is true. You know, consumer prices are up 4.2% from a year ago. So from April of 2020 through April of 2021, we saw a 4.2% increase in consumer goods, while producer prices are up 6.2%. You know, I went through and read the Tyson's earning report where they talked about how the prices of their meat for them and for their suppliers has drastically increased. And so that's going to be a byproduct of this huge imbalance that we have between retail sales and manufacturing. And so what does this mean long term? Well, it doesn't mean the sky is falling. It just means that we need to be aware that whenever you do things from an economic policy standpoint, from a stimulus standpoint, that's never really been tried before, you maybe are setting yourself up for some issues into the future. And so this doesn't mean that you need to sell all your stocks and, you know, put it into a rainy day fund, because if you do that, well, you're going to be losing purchasing value as inflation goes up. And so you need to stay invested. But things you can do when the economic times are good and improving like they are right now, pretty straightforward. First, get your financial house in order. Pay off your debt. Build up your cash savings. Make sure that you have your investments lined up and you truly are good with where you're sitting, just from a basic financial standpoint. Second, understand your risk in your investments specifically. Make sure you know what your potential downside is during a market sell-off and what your upside is. A lot of people over the last 12 to 18 months have really seen the amount of risk in their investment accounts actually creep up, just because of a byproduct of markets are going up, we're making money, that's a good thing, and people's risk tolerance naturally goes up. It's whenever you start seeing imbalances in the underlying economy like we're seeing now, that's a really wise idea for you to consider, hey, am I taking too much risk right now? Do I need to maybe take some profit off the table? And that's really a great time to be doing that. And so my two things to encourage you to do would be, one, make sure you're getting your financial house in order, pay off your debt, build up your cash savings, and two, really understand the amount of risk that you're taking in your investment accounts. And so that whenever the good times maybe hit a wall, or we see some volatility creep into the market in a more drastic way to the downside than what we're seeing now, you're fully prepared for that and you're able to stick it out and not make a decision that hurts yourself in the long term. If you have any questions about this, don't hesitate to reach out to myself or one of our advisors. We would love to chat with you. Thanks for your time, guys.